Hello, I'm Ralph Benson, co-founder and head of financial advice at Moneycube.ie. With me today to discuss investing in Asia Pacific is James Thom, investment manager of the Aberdeen New Dawn Investment Trust. Aberdeen New Dawn is focused on investing in equities in Asia Pacific, excluding Japan, and has a market capitalization of around €350 million. The fund is up around 40% over the last 5 years, so a strong result, particularly when you think about the specific impacts on China, one of its key regions, of the COVID lockdowns, which of course are still with us, and the wider sell-off that we've all experienced in equities globally during 2022. As a business, Aberdeen as an asset manager has always had a strong focus on investing in Asia Pacific, and James himself is based in Singapore. So one of the things we're going to talk about today is the merits of a local, active approach to investing in this region. James, you're very welcome to the discussion, and maybe we could begin by hearing about how you came to fund management and to investing in Asia in particular.
Yeah, thanks. Great to be with you. So I've been based in Asia, in Singapore for 17 years now, and my interest has been, I think, predates that move really. I've long held a fascination with emerging markets more broadly, and Asia more specifically, and just really the huge opportunities from an investment perspective, from a growth perspective. Asia now more than ever really is the engine of the world's growth, and with that just makes it an extremely exciting place to be investing and to be working in. And so I've kind of pursued that initially as a private equity investor, and in the last more than a decade with Aberdeen on the public equities side.
Yeah, and I guess there are some fundamentals which drive growth in Asia, which are, if not unique to the region, definitely much more prominent than, say, Europe and North America. There's a lot of change to demographics in a positive sense, I guess. Is that fair to say?
Yes, obviously, it's home to a huge swathe of the globe's population. So China with 1.4 billion people, India with another 1.4 billion. The demographics vary actually quite markedly across the region. So actually, although China has a very large population, the demographics are on the cusp of kind of working against it, I think, with an aging population. In contrast, you've got India with the so-called demographic dividend still, with a growing population and a very young population, which will certainly, assuming that India can keep creating jobs for its millions of new individuals entering the workforce, will continue to drive structural growth for many decades to come in that market. So yeah.
Is it also the case that, like, I suppose even if you look at China, it's not pure demographics, but it's also kind of rising education levels, rising middle class and income levels. I know, like, you've invested in like auto dealerships in China, for example. I guess is that part of the investment thesis behind that?
Absolutely, yeah. So notwithstanding maybe a sort of slowing or aging demographic in China and that risk, your point around the middle class still emerging and still getting wealthier is extremely valid, and is continuing to drive a real domestic consumption story in China. And so the auto dealership is a great way of playing on that, as people sort of aspire for the sort of marquee brands and in the auto sector. And we see that right across the sort of broader domestic consumer story in China and elsewhere. So and the trust is very much positioned around that.
Yeah, I suppose. And I mean, even if we think about our own society here in Ireland as it ages, I guess that's where all the money is anyway, right? So young people are kind of driving the growth perhaps, but the wealth often resides in the older consumers. I guess maybe you could tell us a little bit about the fund itself then, its overall strategy and its approach to allocating investments. Be good to hear.
Yeah, so as you mentioned in your kind of opening comments, it's an Asia Pacific ex-Japan equity strategy. The objective is long-term capital appreciation. So it does pay a bit of a yield, or have a bit of a yield, but it's not explicitly targeting income. The sort of strapline we use for the fund is investing in locally chosen high-quality Asia Pacific companies. And that tells you a little bit about how we approach investing in the region. So we have a long-term quality approach. So it's neither growth nor value. What we're trying to do really is just identify the highest quality companies across the region and build the portfolio from the bottom up around those companies, ultimately aiming for a reasonably diversified portfolio, both geographically and across sectors. So that's the sort of the broad overarching strategy and approach.
Yeah, I mean, I suppose one of the things that struck me about it is, here in Ireland, like we've been debating quite a lot about, there's a cyclical thing coming of the sell-off in growth, and arguably not as much as you might hope of a cycling into value stocks. But actually, when I look at if you like, the technology stocks that you hold, and keeping in mind that one of the best things you can do as an investment manager is avoid losses and miss bad opportunities as much as capitalize on good ones. It feels like, say some of the retail oriented technology stocks, you've either sold out of at a good time or had a very low exposure to. I'm thinking of the likes of an Alibaba or Meituan in China, whereas perhaps it'd be just good to hear some of the technology stocks you have built a position in, which, if you like, seem to me more business to business, less kind of prone to the vicissitudes of the market day to day, but also political risk in China. So, for example, I know you've taken a position in a lithium ion battery separation business and some of the stuff around automation in industry. It'd be good to just hear about that.
Yeah, so we have some exposure to the Chinese internet sector, but we've been pretty cautious around that for a couple of reasons. The Chinese government has been trying to kind of clean up that sector somewhat and eradicate some of the kind of competitive practices that were happening. So we've been cautious there, and obviously it's tied to the broader growth story, and China's been slowing lately. So we've kind of done well, as you say, to kind of limit our exposure there. In contrast, when you think about the broader tech exposure in New Dawn, we have quite a bit of exposure to the semiconductor sector, so sort of tech hardware, I guess, and that is cyclical as well, and there is absolutely concern around what the risk of global recession might mean for these companies. But actually, two of our larger holdings in the portfolio are semiconductor businesses and are, I think, amongst the highest quality companies in Asia and stack up very favorably on the global stage. Our largest holding is a company called Taiwan Semiconductor Company, or TSMC as it's known, which is by far the global leader, way ahead of Intel and other companies that you may have heard of in this sector, with north of 80-90% market share in its really advanced technologies. So very happy to hold those companies. It's been a great long-term compounder for us, and whilst you have to sort of reposition slightly around the cycle, we still think the sort of medium-term opportunities for those companies are extremely robust. And then, yes, as you mentioned, delving into slightly more sort of niche pockets of the technology sector across Asia. So we have invested in an industrial automation business in China. So this is benefiting both from this trend as China has become wealthier and more successful. Wage levels have gone up, and the cost of labor, which used to be very cheap, is now rising. And that is forcing Chinese companies to increasingly automate their factory floors. So this business plays into that theme. There's also in China, and this touches on some of the geopolitics, I guess, the region, and China specifically. China is, where possible, trying to foster a domestic and local industry and players that are homegrown versus being reliant on multinational companies. And so this company is a play on that sort of localization theme as well. And you mentioned the lithium ion battery separator. So that is a sort of very niche, high-tech business in China. So it's a play on the electrification theme. So that as the world accelerates its move towards electric vehicles, which, by the way, China has been leading the world on. Electric vehicle batteries are clearly a critical component there, and this company has a market-leading position globally, not just within China, as a component provider into battery manufacturing. And yeah, it's very interesting. China is, you may be surprised, it is home to many kind of niche but globally competitive and sometimes leading component makers in the technology space.
Yeah, so it's interesting just hearing you talk about it. It sounds, a lot of the decisions or the root of a lot of your investment decisions has been quite sector led, as in here's a sector where we think an interesting story is going to unfold, and actually, as you say, there'll be a market leader in China which is rolling out globally. So tell me a little bit about your investment process then. Like where does it start? I think one of the things that's distinctive about the fund is, it offers a way to get exposure to markets that are less talked about around here, Vietnam, Indonesia, these kinds of places. Does it start from a geographical perspective, from a sector perspective? Is it opportunistic, with meeting good management team, or where do you tend to begin when you're looking at opening a new position?
Yeah, so I've got the great benefit of having a very large team within Aberdeen down on the ground in Asia. So we're more than 40 fund managers across 7 offices in Asia. And that is a fantastic resource in terms of research generation and idea generation. And we organize ourselves. So obviously we have offices across the different geographies, but we also organize ourselves from a research standpoint by sector. And so we've got this kind of matrix structure where we're able to have this research engine generate ideas both within specific geographies and within specific sectors. And so every 2 weeks we're for example running through a particular sector and trying to both review what we already have in the portfolio and the stocks we already hold, but also thinking about what new themes are there, what that we should be focusing on. Are there ideas and companies within the region that we can be investing in? So that's a really important driver for idea generation. Ultimately, I would say the caveat is it doesn't matter how exciting a particular thematic may be. If we can't find a company within that sector or niche that meets our fundamental quality criteria, we won't invest. So that's where the buck stops, if you like. It's a bottom-up, quality-driven investment process, and so we have sectors. I think education would be a great one. Clearly, to the demographic discussion earlier, great growth in that sector in Asia and demand for education as families and households become wealthier. But for whatever reason, not many companies in the listed space, and those that are listed fail our quality criteria. So at the moment, New Dawn doesn't have exposure to that particular theme, although we've identified it as an attractive one.
Yeah, sure. Okay, that's very interesting. I guess also we need to, you mentioned India at the start there. We need to delve into India a little bit. You've invested in India via a holding in another Aberdeen fund, which makes it your largest holding, but of course in itself highly diversified. So it'd be good to, if you could just tell us a little bit about that and what it represents for the fund at something like 12.5–13% of the overall exposure.
Yes, and I appreciate it's a slightly unusual way of investing through a fund like that, rather than going direct and given we are stock pickers. The reason we did that is because there were tax benefits to investing indirectly from a capital gains standpoint versus going direct. However, in terms of reassurance, the India fund is managed by the same Asian equities team. I personally am very closely involved with the management of that portfolio as well, which tells you that it's run to the same strategy, well, not the same strategy, but the same investment process. So it's also long-term quality focus built from the bottom up with exactly the same rigor and sort of selection process. There's no double charging of fees, so in that sense, it's entirely transparent. Within the fund,
you'd be disappointed if your colleagues on the India fund hadn't given you a good rate, all right?
Yeah. No, it's so. I mean, it is fully transparent, and within the fund itself, there are just under 40 holdings, so between 35 and 40 holdings. So it's also an active, pretty high conviction portfolio, very much biased towards the larger top 10 holdings, as with New Dawn. And it gives you a diversified exposure to the Indian equity market. There are some sizable positions within the consumer sector there as well, within IT services, with India home to some of the world's leading IT services companies, competing head on with the likes of Accenture and so forth. It has a large exposure to the financial sector and banks in particular, which at the moment are doing very well in India. So it's a sort of nice way of getting a diversified exposure to a high growth market, which is packed with really great quality companies and has long been, I think, for New Dawn, we've always held a sizable position in India, and that tells you or gives you a sense for our view on the quality of the underlying companies there.
Yeah, absolutely. And I guess a different set of political risks perhaps to say Chinese exposure as well. I guess sitting as I am here in Dublin, we've had quite a year. It doesn't feel like that long ago before we were kind of 2022 was opening, and the talk was of the roaring 20s as all the money we'd saved sitting at our kitchen tables would be spent in a big splurge on restaurants and travel and all these other things. And fortunately, the central banks were telling us how the inflation we were seeing was merely transitory. Here, roll it forward 9 months, it all looks rather different. It didn't take long for war in Ukraine, which is firstly, appalling from a human perspective, but also has had a major financial impact, particularly in Europe, on energy cost and inflation as central banks rush to catch up on that. But I guess, from where you're sitting in Singapore, maybe that looks a little different, and there's a different set of risks and opportunities. Attitudes towards Russia are different, and trading with them, and I guess arguably, Singapore, a major energy hub in Southeast Asia as well, that may be kind of driving activity and prosperity rather than costing consumers money. So it'd be good to just get a sense of the overall mood and how you see it differing versus say here in Europe.
Yeah, so I think I think the mood in Asia is relatively cautious as well. Asia as a region may have a very different set of dynamics, and I'll talk about that shortly, but ultimately it's still an interconnected world, and Asia is very much dependent on the global economy and integrated with the global economy. So I think fears around recession in the West and what that might mean for global demand and export demand for Asian exporters and countries that are particularly sort of dependent on exports are a concern. So, and when you look at the market, certainly Asian equities have not escaped a lot of these headwinds as well. So broadly sort of tracking similar to global equities at the moment. Having said that, I do think that the underlying fundamentals in Asia are quite different, and the issues whilst similar, are much less acute in Asia. So to give you an example, inflation. So we're seeing kind of double-digit inflation in the UK, in the West and Europe, and more broadly in Asia. Inflation has been rising, but not nearly at the same sort of rate. And for the most part, it is trending at around the sort of upper bound or threshold of central banks' kind of target ranges. So we have seen central banks respond to that a little, and rates have gone up a bit. But again, there's not the same sort of pressure to rapidly accelerate rates. And I think central banks just have a bit more headroom to do that in a more measured way, which will be less disruptive to growth in the near term. China is cutting rates. I mean, it couldn't be more different. Inflation's about 2%. So really totally different set of dynamics there. And there is still growth. So I think there is notwithstanding that sort of export linkage, and vulnerability to slowing global growth, Asia is still on course to grow at sort of 4 or 5% this year from a GDP standpoint. India, since we were just talking about that, is forecast to do 7 to 8% GDP growth this year. And that filters down through to the companies. So we're still seeing earnings growth. We are having downgrades come through. So whereas at the beginning of the year, maybe the expectation was for double-digit earnings growth this year, now we're down to sort of high single-digit earnings growth. But nonetheless, still growth. Those sort of structural undercurrents are still in place and still helping to sort of drive a sustained level of growth. So I am, as I say, in the round, I think, yes, there are headwinds in Asia and you need to be cognizant of those, but the situation is at this point, far less acute than elsewhere in the world.
Yeah, okay, well, that's maybe a good point to just kind of ask a closing question around where you see the fund, kind of the opportunities for the fund into 2023 and beyond. So it'd just be good to hear about, the opportunities you're considering in a general sense, whether it's sector, geography, and so forth, and where you're directing your time alongside your fellow managers.
Yeah, so I think for the balance of this year and going into next year, we are a little bit cautious on China, and we haven't really discussed it, but this is a country that's still effectively closed to the rest of the world, still pursuing a zero COVID policy, still seeing lockdowns in important cities and large parts of the population, and so that is being incredibly disruptive, as we all know, to economic activity, and so we're seeing very slow. So just being a little bit cautious on China. I think when that zero COVID policy gets reversed, perhaps towards the end of this year, we will see a meaningful rebound in the Chinese economy. There's, as with all the countries that have sort of finally emerged from the pandemic, there's always huge pent-up demand, and I think China will be no different. So, maybe turning a little more constructive on that into 2023, but for the moment, somewhat cautious. In contrast, more constructive on India. As I said, an economy that's going to do 7 to 8% GDP growth this year and is home to so many great quality companies. It's a very obvious sort of hunting ground for us. So we've just been slightly increasing the position to India lately. And we've been looking for ideas in Southeast Asia. We're already well positioned there across, Singapore and Indonesia, Philippines, Thailand, but we'd like to find more opportunities there. It's a market or region that has been somewhat out of favor, I think, for many years now, 7, 8 years, and is arguably finally getting its mojo back. It's reopening post-pandemic. Growth is picking up a bit. It's a large population in aggregate, and some very interesting sort of consumer stories there as that, back to our early comments, that middle class rises up. So we've got quite a bit in the bank sector there, and obviously those are nice hedges against rate rises and the inflationary risk. So those have done quite well for us, and I still think the outlook there into next year is quite constructive and positive.
Yeah, and presumably, James, I suppose there is a flow of capital and talent, isn't there, out of Hong Kong and into Singapore, kind of at the heart of that region. Is that influencing your decisions?
I mean, I think that is happening, but I think it's from a Singapore and financial standpoint, we're seeing considerable growth in the private banking and wealth management sector in Singapore. And so some of the bank holdings that we have in the trust benefit from that. I mean, they're sort of universal banks, but they have large and growing private banking and wealth management businesses. So yes, on the margin, but I think typically where we can, whilst Singapore companies are often very high quality and well governed, the Singapore market itself is pretty small. So we tend to look at companies that are trying to sort of tap into the larger growth opportunity in some of the more emerging markets like Indonesia, Vietnam. We've talked about, it's 100 million population there and getting wealthier. So I think that's where we're trying to sort of look for ideas.
Yeah, great. Look, James, that's been a really helpful conversation to get a sense of your fund, how you manage it, how you have managed it to deliver strong returns, and some of the opportunities you guys are looking at to do more of the same in the future. So great to talk with you today, and thank you very much.
Thank you. My pleasure.